5%. That's all you need to buy a house in Canada, at least on paper. But is it actually enough? Or is it setting you up for a financial trap you won't see coming? In the next 8 minutes, I'm going to break down exactly what the 5% down payment rule means, what it's going to cost you long term, and whether it's a smart move or a mistake. Let's get into it. This video is for anyone who's been saving for a down payment, who keeps watching home prices move, and who is asking themselves, do I wait until I have 20%, or do I just get in now with 5%? That's the exact question we're answering today, with real numbers, no fluff. Let's start with the basics. In Canada, the minimum down payment depends on the purchase price of the home. For any home under $500,000, you need just 5%. For homes between $500,000 and just under $1 million, it's 5% on the first $500,000 and 10% on anything above that. And for homes priced at $1 million or more, you need a full 20% down, no exceptions. That one surprises a lot of people. So right away, your down payment strategy changes dramatically based on the price of the home you are targeting. Here's the part most first-time buyers don't see coming. The moment your down payment is less than 20%, the government requires you to get mortgage default insurance, most commonly through CMHC, the Canada Mortgage and Housing Corporation. Now here's what you need to understand. This insurance does not protect you. It protects the bank if you stop making payments. And yet, you are the one paying for it. It gets added to your mortgage balance, and you pay interest on it for the life of your loan. It's one of the most misunderstood costs in Canadian real estate. Here are the actual CMHC premium rates. If you put down 5%, you pay a 4% insurance premium on the entire loan amount. At 10% down, it drops to 3.1%. At 15%, it's 2.8%. And at 20% or more, you pay nothing. Zero. Let me put that into real dollar terms so you can actually feel what this means. On a $600,000 home with 5% down, that's $30,000 down. Your loan is $570,000. The 4% CMHC premium on that is $22,800. That gets added to your mortgage. You are now borrowing $592,800. And you are paying interest on that extra $22,800 for the next 25 years. Let's make this real. You are buying a $600,000 home. With 5% down, you put in $30,000. After the CMHC premium, your actual mortgage becomes nearly $593,000. At a 5.5% interest rate over 25 years, your monthly payment is around $3,490. Now compare that to 20% down, $120,000 upfront, no CMHC insurance, mortgage of $480,000, monthly payment around $2,825. That's a difference of about $665 every single month. Over 5 years, that's almost $40,000 more you'd be paying, just because you went in with 5% instead of 20%. There's another layer most buyers underestimate, the mortgage stress test. In Canada, even if your actual mortgage rate is 5.5%, the bank has to qualify you as if you were paying 7.5%, that's your rate plus 2%. This stress test reduces the maximum amount you can borrow. And since 5% down buyers are already stretching their budget, this hits them harder. You might qualify for less than you think. Before you fall in love with a home, get a pre-approval and know your real ceiling. So when does going in at 5% actually make sense? First, if home prices in your market are rising faster than your ability to save. If waiting 3 more years to hit 20% means the home costs $100,000 more, the math might actually favor going in now. Second, if you have a stable, growing income and can comfortably handle the higher monthly payments. Third, if you are buying in a city with strong long-term demand, like Toronto, Vancouver, Calgary, or Ottawa. The CMHC premium stings, but building equity in a rising market can offset it over time. On the flip side, when should you wait? If the monthly payment at 5% down already stretches you thin, you are taking on real risk. What happens if rates rise at renewal? What if your income changes? You have no buffer. Also, if you are carrying credit card debt or car loans at high interest, paying those off first will improve your financial position more than rushing into a home. And if you are in a market that's flat or softening, you won't get the appreciation to offset those CMHC costs. If you're working toward a bigger down payment, you need to know about the First Home Savings Account, the FHSA. You can contribute up to $8,000 per year, up to $40,000 lifetime. Your contributions are tax deductible, just like an RRSP, and when you withdraw to buy your first home, it's completely tax-free, just like a TFSA. It's genuinely one of the most powerful savings tools the Canadian government has ever created for first-time buyers. If you're not using it, open one today. Let's bring it all together. 5% down is the legal minimum in Canada for homes under $1 million, but it costs you significantly more over time through CMHC insurance and higher monthly payments. The more you can put down, the better your financial position at the start. The stress test means you need to qualify at a rate higher than your actual mortgage, so get pre-approved early. And if you're still saving, the FHSA is your best friend. Use it. If this helped you understand the real cost of a 5% down payment in Canada, smash that like button. It genuinely helps this channel grow. Subscribe to PR Wealth Lab for weekly videos on Canadian real estate, investing, and building real wealth. Drop a comment below with your question. What's your down payment goal? How close are you? I read every single one. See you in the next video.